So now, welcome everybody. This is a sponsor spotlight with Resaca Sun Feeds. Andrew is going to continue the conversation he was doing pre-session here on commodity grain prices and what that means to you as a pastured poultry farmer. Welcome, Andrew. Thanks for doing this. Take it away.
Well, thank you, Mike. I appreciate it. I'm going to go ahead and actually take my video off because I will get distracted by it. So I'm going to move Zoom away. So please don't judge me for that because I don't want to take it. So I'm going to minimize that for a second. But I appreciate the time that y'all have given me today to speak a little bit about commodities and other things. But I'm Andrew Moore. I'm from a little town called Resaca, Georgia. That's in the northwest corner of Georgia. And so I was given the opportunity to move back to the farm in 2008, and our farm started many years ago. And so I'd spent the last 5 years teaching and coaching in Macon, Georgia. So my background is actually in music and psychology, much like a lot of other people that are in the pastured poultry business, is that you don't always start out doing farming and you end up there because it's a passion. So I was called to teach special education and coach football and soccer and wrestling. What I was told that I was a football coach that had to coach soccer and wrestling. So that's what I was told. But I returned back to the farm in 2008, and over the past 10 years, things have developed and changed. And so I'm going to go through a little bit of that stuff. So today, the topic of the conversation is how grain commodity markets are affecting your feed pricing. Um, we'll be covering a few of these topics, and on the agenda, this agenda is designed to help you make different decisions on your farm. But I need to explain how our farm and our enterprises are similar to you. Yes, there is a difference in the size and other things, but we still have to make the kind of decisions that you have to make on your farm. So we're going to briefly cover, and I say briefly, it might be a little bit longer than briefly, but briefly cover commodity markets and basis and how they influence your bottom line. Then we're going to lead up to what has happened over the past 3 months with the commodity markets and what to expect over the next 8 months in the 2021 crop year. So let's get started. Moore Seed and Grain Farms started in 1955 when Gus Moore, this man right here, traveled with his young wife, Dale, with their 2 young sons, Tim and Joe, to Resaca, Georgia. In 1958, my grandfather started building these facilities, these grain handling facilities. We've done everything under the sun when it comes from 1955 forward. We've had a sow operation, we've had chickens, we've had all kinds of things. But today, what we are is we're an 8,500 acre farm, and that's double crop acreage. So we farm right around 4,000 acres of barley, canola, black oats, and wheat for winter crops, and we double crop that acreage. So corn, we actually do a cover crop in front of corn, but our soybeans and our sunflowers are double crop behind our canola and our cereal grains. So we produce 7 crops every 5 years on every acre, or 5 crops every 3 years on every acre. And so we have a diverse, sustainable business when it comes to row cropping. But as you can see in these photos here, this is my son's. And this is in a canola crop. So this canola crop will come off and it'll be harvested in June, and then we'll immediately follow with double crop soybeans. We only produce non-GMO grains on our farm. We made that transition in 1955. And all of these ingredients, we were a corn, a soybean, and a wheat farm prior to 2008. And we added in these other crops because of our feed mill and our oil mill. Right now, our farm has right at 1.2 million bushels worth of storage, and we produce enough corn on our farm for 2.1 million birds at an average corn usage in a grower feed. So moving on ahead, we do have livestock. We've been having livestock for a long time, but here's an example. We're just do pasture-based livestock now. We have 1,200 layers. We started off just having 30, and that grew because I wanted to be able to test what our feeds were doing and other things. And so we added in a lot more layers to that. We have a pullet program now that we're growing out pullets and reselling pullets. But these are two photos of my boys a few years ago with the chickens. They love laying hens. And then a swine, we have a farrow to finish swine, a pasture-based swine program. So we understand the struggles and the benefits that and the things that you have to go through on your farm. So moving on ahead, More Seed and Grain Farm sells their grain to recycle some products on the oilseed side of it. So canola, soybeans, sesame, and sunflowers is what our expeller press business does. We started in 2008 after I moved home, expanded to the size we are now, where we process right at 50 tons of these grains a day. And again, all these are non-GMO. And so you see the video here of oil being processed out through the press. It's different than what is traded on the market that we're going to talk about in a few minutes. 48% soybean meal is what is traded on the commodity market. Well, our product is not 48%. It's 44% protein that has 8% fat in it. And it is traded on a different basis than soybean meal is. So if we're looking at this production here, we physically press out the oil, and this is the cake or the meal that's coming out on the bottom. We grind it down. We send it through a hammer mill because it has to cool and other things to be able to use it in your feed. So it's ground down here. This is a photo of that was took the other day. We have the capacity in our oil mill to be able to run about 15,000 acres of oilseed crop. We don't run that much, but we do have that capacity. So now on to the third business that we started in 2011. Again, it was started by Joe, Tim, and myself. Joe is my dad. Tim is my uncle. We all lived, or they live on Fight Bend Road, which all this where our home base is in Resaca. And so we only produce non-GMO feeds. We use the ingredients. About 90% to 95% of the ingredients that we use in the feeds are produced on our farm in our oil mill. We pellet and we bag and we mix feeds, but really the big one that we move is a lot of bulk totes and bulk auger totes. We do business in 50-pound bags, but ultimately our biggest thing that we do is in bulk totes and bulk auger trucks. So you can see a video. This is actually taken many years ago. Actually, it was probably taken in 2014, but of what our process is. We do a lot of belt conveying and other things, but it's loaded out into bulk totes. And this is a photo of my son that he is standing on a bag, a truck full of bagged feed, delivering with me. I make a lot of deliveries, but we deliver direct to farm. So to get to I wanted to give you that back plug or that back information because it directly influences your feed prices. So two of the businesses that we have, More Seed and Grain Farms and Resaca Sun Products, are part of this three-legged stool that supports the price, your feed price, and the price delivered to your farm. So Resaca Sun Feeds really influences the three-legged stool here through production and logistics. We add value to the crops that we produce on our farm and our oil mill by just turning it into a marketable product for you, really focusing on what you need for your business. So then looking on into logistics, we have our own trucks. We run our own feed trucks and our own trailers and everything, delivering directly to farm most of the time, or at least into a regional area for you. We have a great group of men and women that show up to work every day, ready to make your feeds. And so it is, so we can keep the production cost as what they are. But the biggest influence that has on your price of your feed is your commodities. So if we look at an average broiler grower, and this is one actually taken from Jeff, this is one of Jeff's formulas for Trail that uses roasted soybeans, corn, and expeller press soybean meal. And of that, it's going to use, I believe, 84%. I believe that's the number. It's going to use about 84% of commodities in the feed. So you can see that influences the price substantially. I do want to point out that our enterprises that we have, even though we do everything on farm and everything within our businesses for those ingredients, we don't have any control of what the commodity prices are doing and commodity markets are doing, other than that we hedge as best we can and try to protect those prices. So we hedge on the commodity markets or through futures contracts on the commodity markets, or we sell to, the way that Moore Seed Grain Farms is that they sell to sales contracts. So Moore Seed Grain Farms is the base of our business. So I do want to, before I go ahead with these commodity markets, I'm going to stop right here and I want to clearly explain this. Commodity markets are constantly moving, and speculation within these commodity markets is extremely volatile and risky. It's the only market that you can invest money into and lose it all, plus owe money at the end, called a margin call. So I am not making any recommendations on how to trade futures or doing speculation for investments or anything. I just want to make sure that that is clear on this conversation, because that's beyond the scope of this. So brief overview of what a contract is for the commodity markets. And this is important because you got to see how the feed mill hedges and how it goes and it moves beyond just what your price of your feed. So let's just look. These are all publicly traded commodities. So we got corn, soybean, soybean meal, soybean oil, wheat, oats, and rough rice. Out of all these, we trade on the top 6 here. So let's just look at corn, for example, here. So there are contract months that are based, and the current contract month that we're in is March right now. A 5,000 bushel is the contract size. So I'm going to zoom in on this a little bit more so you can see it. So it's a contract size of 5,000 bushels. So if you look at that number, 5,000 bushels is equivalent to 280,000 pounds, which is enough feed to feed 56,000 chickens for one contract on it. So the majority of everyone here is probably not going to be able to trade and hedge on this market for corn, because it's beyond what you have the capacity of buying or selling for corn and your usage. So if we look at all of our products that we use in our businesses, they're all non-GMO project certified, and the commodity markets do not care about genetic traits. All they care about is the quality of the product. And that's what gives number 2, I think it says number 2 yellow corn. That's a certain standard, and you can look at all those standards up. Soybean meal, like Jeff and I were talking about before, soybean meal is based on 48% protein. So that's the standard at which it's sold, and 5% and 0.5% fat. That is hexane solvent extracted soybeans. And so like our Expeller Press soybean meal has an 8% fat level and 42 to 44% protein. So soybean meal and soybean oil commodity is the base of all plant proteins that you would use, plant proteins that you would use in the feed. So let it be linseed meal, let it be canola meal, any of those meals, sesame meal, they all trade on that soybean meal market. That's how they hedge, how we would hedge on those. So we're really going to focus on the energy side in this conversation, the energy side, which is corn, and but wheat and oats are also on the energy, but the standard is set at corn. So let's talk about right now 2021. So the past 3 months has really been the beginning of the cycle for the crop year 2021. So right now, corn production, this was released as of January 14th by USDA. Currently, USDA lowered their projection on corn, and this is a big number I'm going to put out there, but 14,182 million bushels. It was lowered by that amount. What it did is it actually reduced the national average by 3.2 bushels per acre, which is significant. So in this report, they also projected that there was actually less ending stocks for the year. So when that happens, when you have reduced production and reduced ending stocks, you will see an increase in price, which you can see this here in this box here as a chart for the last month and a half. So as you can see up here at the top, corn is trading on the commodity market. Commodity corn is trading at $5.31. These 2 other lines that are listed here, the 2 other lines that are listed at the bottom, I'm going to zoom back out. Sorry, two other lines. Let me get back to it. Sorry. The two other lines that are listed here on this, they are moving averages. The market's always going to make a correction at some point back to those moving averages. So you can see that there's a good separation to it. But right now, everybody is, from what I've been told and heard, there is a cap to this. The first mark was this $5 bushel here, which is at this point. Now there's not a lot. Nobody knows what's going to happen with it. So to talk a little bit more about corn, a corn bushel is 56 pounds. Currently, the price is trading at that $5.31. And so when you look at the close month, that's what we're showing to you is the March month. It's $5.31 here on the lower right-hand side. And so with that $5.31 on the lower right-hand side, those are the ones, so you can get this information at agweb.com, and I've got some links. I'll share the links, but watch the market. So you can see that in March, it's at 531, and then you go on down to next year, which is this December month, or the new crop, which would be September and December, is trading less. That's significant because right now, as a farmer, they're more encouraged to sell the short term, and then instead of carrying over stocks into the new crop year. So that means we're still going to have a depleting stock. That also means that the price is lower at harvest because harvest happens between September and December. This is a lot of information, and I know that, and it's a lot of stuff to digest at one time. Normally, commodity markets take a while to understand, and basis is a big one. That is usually something that is hard to understand for most people and most farmers, because it is this ambiguous number that is not clear. So I've had producers come to me and say, hey, what's corn pricing at? Well, I see that it's on the market at $5.31, but you're selling it to me at, let me just throw out a number, at $7. Well, this is a good slide, and I'm gonna zoom in on it for just a second. Is that this slide here is the current CBOT price, which is $5.31 per bushel. And I'm gonna underline those for you or highlight them. Let's see if I can do that. So there it is, and I'm going to highlight the other area for you and zoom back in on it. So on this $5.31 corn that we're talking about, well, basis is that price that is the local cash market price minus the futures cash market price. So we can see that the local cash price for the northern panhandle of Texas is $5.61 at an elevator. And so the difference between this number, the $5.61 or $5.80 minus 531, gives you a basis of $3.49. But that's at the county elevator. But if we go down here and we look at livestock feeding operations, somebody that you're just delivering to that has beef cattle, again, beef cattle, you're looking at a basis of 521 to 527, which gives you the cash price or the market price of $6.53 to $6.59. How does that influence you, and how does that influence what you're doing at your farm? Is it depends on the region that you live in. So, and how you get your crop and how you get your feed. So you can't look at the market just as the price. You have to know what the basis is. So again, let me keep on going just for a few minutes longer. And that is, this demonstrates what the pricing has done over the course of the years. Over the last 5 years, you can see that this price is based on November for cash commodity price. You would see corn up here for January, well above those numbers. And the same thing, this is giving you an idea of the price. This is a basis, the cash price for Central Illinois is the bottom line, and the top line is Louisiana. So soybean protein products, real quickly, I'm gonna go through this, is that soybean meal is a standard as which we price it at. You can see the ending stocks have decreased for this year versus the last 2 years. And where ending stocks have gone down and domestic use has gone up and exports have gone up. And so that is going to increase the usage. So here's the usage. This usage is going to be greater than production. So you can see the supply and demand going up. I'm not going to go into the details of how many million bushels that are over and other things like that. If you want more information, all this is based on USDA data and information you can get from ERS, and I'll put those links later. So what does this mean for you as a pastured poultry producer? Is that the major commodity markets have already reflected this commodity, the commodity decrease in yield and increase in usage. Now we're waiting to see what happens with exports and planting acreage on how that will influence the pricing. Most feed companies are hedged on the market for the near months, and the feed market usually doesn't reflect commodity market changes as quickly as the commodity boards do, unless there's a big change in the basis, like we've seen over the last 3 to 6 weeks. So how do you as a producer protect your margins? It sometimes means that you're probably going to have to prepay for the feed to set your price on the feed, even though you can take delivery later during the production period. Some feed mills will do that, some won't. So I would definitely contact your feed mill supplier and see if they can do prepayments. And if you have a price that is locked in at, especially if that price is moving with the markets, like normally your feed mill that you work with will move with the commodity markets. So if you watch the commodity markets and you see that they're lower, then and you know that your price is lower than what you normally pay, then you can prepay for that product to lock it in. There's some other things that you could do potentially. It depends on your feed mill. You can do forward contracted or futures contracting. Let's say if your feed mill, let's say you're large enough and you want to buy corn, and you buy corn and you send it into their feed mill and you lock in that price for that corn. There's all kinds of things to do, but the majority of people are not going to be able to do that. So what I would recommend doing is doing a prepayment to hedge your price. And so I'm not saying that you should do a prepayment for all of it. It depends on where it is. So if you know, um, so if you maybe you hedge your risk at maybe 30% of what you know that you're going to use. So if you're factoring in 12 to 13 pounds of feed for total feed for an 8-pound bird, and the number of birds, and so you say, well, I want to protect 30% of that, you can always do that too. So wrapping this up, the cash market price will always be higher than the prepaid or contracted price. I shouldn't say always, because sometimes you'll prepay for something and the price will go down after it. That's part of hedging, but you are locking in what your cost is going to be on your feed when you prepay for something. And so then you're no question on how much it's costing you to do that. I would recommend negotiating and talking with your producer or your feed mill, and saying, hey, can I lock in those prices of those feed? So right now you see that the short-term commodity prices, like I said earlier, in the market is really high. I mean, it's higher than it's been. It's like 67% higher than what it was, 6 months ago. Uh, so if you look at the futures market, you'll see that new crop corn is lower, like I said. So maybe now's not the best time to prepay and do a futures contract for your corn, but it's at least start the dialogue with your feed mill, because historically, when you get closer to harvest is when you see a reduction in feed pricing. And so if I have a producer that calls me up and says, hey, I've got 1,000 birds that I'm going to grow out, well, we're going to calculate that you're going to need X number of amount of feed. Well, how much corn out of that are you going to need? Well, for us on our farm, what we can do is that we can estimate on how much acreage we're going to supply or put into usage for our corn. Well, it also matters like soybeans and sunflowers. So we have just an X amount of limited amount of acreage that we can put toward individual things. So, but that decision making starts 3 to 6 months ahead of us actually planning. So this is not a conversation you want to do now if you're planning on talking about controlling your risk 2 months from now. This is something that needs to start happening and forecasting 6 months, 8 months, a year ahead of time, if you can. So I'm sure there are not many questions because I completely covered everything, but that is the end of it. That was a really brief, quick overview of commodity markets and basis, and I'm sure that I was not clear on those, but hopefully I can help answer any questions that you might have going forward. But thank you so much for the time, and I don't really know if I'm over my time limit or not.
You have 6 minutes, I think.
Bam. So questions, comments, or concerns? Paul.
I'd love to ask a question. I don't know how to do the virtual hand raise. I'll raise my real hand for a second. Andrew, thanks for the presentation. It's really interesting to me, especially in a year like this where grain prices are so crazy. They're just skyrocketing like this. If I'm gonna raise 100,000 birds or 1 million birds this year, why wouldn't I buy some grain futures just to protect my price instead of relying on you to do it?
Yeah, I mean, you can. And so that's what we do on our farm. So there's two ways that we can do that is through, let's say that I go to a broker and I say to a broker, hey, I want to go ahead and hedge. I want to go ahead and buy at this price, 5,000 bushels for you. And so I can lock in that price with that broker, and then that broker or that grain handling facility will then manage those risks on their end, because ultimately they're turning into a basis trader. Or I can go on the futures market and buy a contract or sell a contract. Here's the difference is that if you have, so you're at zero, let's say you're at $5 for that corn, and this is where it's going to get way too complicated in this conversation, Paul. But let's say you got $5 and your basis and the price goes up to $1 or $6. Well, depending if you short or long the contract, you have to pay having a margin call the difference between those two numbers times the number of bushels that you have. So you have to have cash flow and some other money to be able to protect those hedges. Now, if you sell the market and it goes down, then you're protected. But if it goes up, you have to pay the difference between the two. So it takes some pretty deep pockets, but it's 5,000 bushels, which is 56,000 birds.
But in theory, I'll have a more profitable chicken at that point. So really, it's just a hedge against my bet. If the mill's passing through the discount, which maybe they're not going to. Yeah,
that's exactly right. Now, and you can do it because you still have a product to sell. So that's the thing, is that if you're doing just speculation, not only you don't have a product to sell to be able to take that cash price minus that futures hedge that you have, the difference between the two. And that margin between those two, if you sell a product like we have corn to sell, I could take it and drop it in Chicago at that cash price when that contract's due and get the difference, and that would cover my hedge. So that's a further level conversation, but yes, you could essentially do that.
Okay. Hey, Andrew, Ginger wants to know if you'll post the slides or if you'll send them to me and I can post them.
I definitely will. Yeah. They have some embedded video, so I'll have to scrub all that first.
And then one question here from Cynthia in the chat. She's asking if it's better to purchase grains from you or via her farm cooperative, because she's smaller volumes, about 1,700 pounds a month.
Yeah, we sell to different size people. I mean, that's not a big deal for us because our feed mill is mainly end user. Our farm we market everything through our feed mill. So yeah, we can sell grains. We do that all the time to individual producers, just like Cynthia. The difference between the farm co-op and us is that it's mainly like with your customers. When they look at you, they're like, oh, well, Cynthia produced this chicken. This bird was produced on, Windy Meadows farm. And so they know the producer that produces it. So when you're looking at the corn that you feed your chickens and telling the story to your consumers, we produce it on our farm. We handle the grain. We have all the production practices of it. So we can talk a little bit better than a local farm co-op can do, because they don't know who makes it. So that's the major difference.
Okay. I think we're gonna end it there. Thank you, Andrew, for that. If you have questions for Andrew, he's accessible via Huva. He's all over the place, so you can message him. You can reach out to him via his exhibitor booth or his sponsor booth on Huva, just like all of our other sponsors. And we appreciate the time and education, Andrew.
Thanks, Mike. Appreciate your time and the opportunity to do it. Y'all continue having a great conference. We all.